Good morning, folks, and welcome to another great edition of Money Truth Moments with our very own money expert, our very own banking expert, and more importantly, our very own money whisperer, right? So, all these titles I'm going to start throwing at you. Thank you guys for joining us. If you're here for the first time, welcome to the show. We have Judy Copenbarger here with us every Tuesday morning at 8 a.m. So, we're very grateful that you get to share our wisdom. We get to spend a good half hour with you talking about what's going on in the world, and more importantly, what's going on in the finance world. With all that said, how are you this morning?
I'm fine, but I don't think I'm a banking expert. I know a little bit about how the money moves, and I would love to share some of that, but I'm not an expert in that. I'm an expert in a lot of other things, but I appreciate the confidence. I'll try to
Yeah.
bring some clarity this morning.
Yeah, folks. And if you're just joining us for the first time, please follow Judy at judycopenbarger.com. Visit our website. We'll talk a little bit more about the resources in our website. And then the reason I also brought up banking today is because we've had a lot of concerns from our audience, especially with all this stuff that's going on right now in the banking industry, right? People are hearing that, oh no, I'm going to lose all my money on this. And other people are saying, well, no, you need to invest on this or pull your money out of this. So there's a lot of conflicting stories out there. And as a consumer, as an end user, right, we don't know any better, right? So we're hoping that today, Judy, you take some time during our show, and I'm going to stop talking so you can kind of guide us a little bit about, tell us what's going on. How do we really look at it from a different perspective? I know that we've discussed before some really exciting stories that you're going to share with us today. Kind of give us a better perspective on that. So floors are yours.
Okay. Well, to understand banking, you need to understand a concept called triage. And that, no, I'm sorry, arbitrage. Triage happens at the hospital. Arbitrage, one of those other ages. Um,
Okay.
so arbitrage is where you leverage the value of the money. And what this looks like it is if you walk into the bank, and you all have probably had this experience or something similar to it. You walk into the bank and you go to one window at the bank, and there's someone there to help you, a teller there to help you, and you say, here's the thing, I've got $100. I want to put it in the bank so you could keep it safe, but I'd like to get some interest back on it. So will you give me some interest back? And in the old days, they had posters, and they had, placards and all kinds of signs saying, hey, you can get 4% interest in a CD for a year, right? And so now everything's electronic, and you have to ask them what the deal is. But that's pretty likely to happen right now. You walk in and you say, "Here's $100 or 1,000 or 10,000, whatever," and we're going to give you, let's say, 2%, just to keep the numbers easy. So when you come back in a year, you're going to get your $100 plus the 2% interest, and that's a good transaction. Everybody knows the deal, right? It's a contract. So then a week later, you walk into the bank and you go to a different window, a different teller, and you talk to a different person, and you say, I need to buy a car. Can I borrow $10,000 to buy a car? And they say, of course. And you say, well, you're going to give me that 2% interest, right? That you're paying me on my passbook savings. Oh, no, 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 no. Your interest rate at this window is 5%. So if you're borrowing money, they're going to charge you 5%. If you're loaning your money to the bank so they can go make money, it's 2%. That difference, that 3% difference that they're profiting, is arbitrage. That's how banks make their money. So then they take the money that's in the passbook savings, all the money that you've given them. It's really not in the basement in a safe. It really is not there. It's somewhere else electronically floating around working. And when banks put money to work, for the most part, they put it to work in the bond system, earning interest, right? Um, and so that's the arbitrage. That's how the banks work. So what's happened right now is the difference between the 2 and the 5% in the area of bonds. And it might make sense to just cover the difference between owning and loaning when you invest, and bonds. Would that be helpful, Carlos?
I was just about to ask you that too, and I think if you do a little bit of a deep dive with that, I think it'll clear up a lot of questions that we have, out there.
Mm-hmm. Yeah. Well, let's do that. Let's go back in time. Let's go back. We have a son who is not a teenager, but let's suppose a few years ago he was, a few decades ago he was. And his name is Evan. So let's say Evan is 12 years old, and he's pretty entrepreneurial still. And at 12 years old, he comes to me and he says, "Mom, I'm an entrepreneur. I want to make some money this summer." and I've got to save it for my car, right? So I'm going to make some money. But in order to start a lawn mowing business, I'm going to need some money because it looks like I'm going to need a, a lawnmower and some gas to put in it. And I'm going to need to make some flyers to let the neighbors know that I'm in business. And so that's what happened. So Evan came and to mom and dad and he said, I need $100 to start this business, to capitalize this business. Anytime you ever see the word cap in your investment strategies or your 401k statement at work or anything in the investment world, cap means capitalize. And that's just a business or some entity raising money to capitalize their business, to build a new wing or develop a new product or to manufacture or distribute what they have. And so capitalize is just that. So you'll see large cap, mid cap, small cap, emerging cap. You'll see all these companies. That's going to give you an indication of the size of the business and how much money they might be raising. So if you like big companies that have been around a long time, that might feel like less risk to you than a smaller company. Where a smaller company or an emerging company might be in its early growth stages where there's a lot of profit and they're really, doing well, as opposed to a company that's been around for a while. So those are things to consider when you're investing. But let's get back to Evan. So he needs $100, and so he comes to me and he says, do you have $100? It's like, no, but I'll give you 10. And you can use that 10 to capitalize your business. Then he goes to dad and he gets $10. And he goes to you, Carlos, and he gets $10. He goes to 10 different people. And we each give him $10 to build his business and get all of the equipment that he needs. And so his business, when he starts the beginning of the summer, when he's 12, for Evan's lawn mowing service, his business is worth $100. So then he's out there all summer long, mowing. And, maybe at that time it was $5 or $7 a week, to mow somebody's lawn. But every time he mows a lawn, we each get a quarter, right? We each get a little bit of money. So that feels pretty good. So we are in business with Evan. We actually own a piece of Evan's lawn mowing service, right? We own stock. We have an interest. We have an equity interest in this business. So every time there's a profit, we get part of it. And at the end of the summer, when his business is now valued at $500 because he has several lawnmowers, he was hiring other kids to help him mow all these lawns. The value of our 10% stake in his business grew. So anytime you see value, it has to do with the stock value growing, what we hold with that company, what it's worth. The other thing that happened is we got all those dividends. So every time there was a profit declared, we got paid. So those are two things great that happen when you own a piece, not loan, when you own a piece of the business and you have an equity stake. And you all know equity. If you own a home, if you own a car, if you own a business and you have some shares that are assigned to you, you have equity. And so when something good happens, the value of the property goes up, the value of the business goes up, you get a piece of that. So that's one way to invest. And that's an equity way to invest. That's not what, for the most part, what the banks are doing. Instead of owning, they're loaning. So should we go through that?
Yeah, because that would really clear it up.
Yeah. So the other way that you can make money other than owning stock or equity is you loan your money. So back to the bank, right? So let's say Evan now is 13. First year in business, he's like, this is great. I made some money. I saved for my car. What I didn't like is every time I mowed lawn, somebody else got part of that money. I didn't like sharing that, right? I didn't
Yep.
like the equity. So he says, I'm older and wiser now. I'm all of 13, right? So second year in business, he says, here's the thing. I need money again, right? Because I've used my money throughout the year. So I need $100. I'm going to buy one more lawnmower. And Mom, can I have $100? No, but I'll loan you 10. Dad, $10, Carlos, $10, everybody else he knew $10. So he gets 10 people to each buy in, but he said, here's the deal. This time you don't own me, right? You don't have a share of Evan's lawn mowing service. I'm not giving away equity, but I'll borrow that money. So if you loan me $10 at the end of the summer, when I've made all this money, I'll pay you back 11. I'll give you an interest. That's a pretty good interest, 10% over a few months, but that's how it works. And so now we're still in business with him. When he makes a profit, he keeps it. but we're guaranteed by contract that we're going to get interest back on our investment with him. We have loaned money. We don't own anything. This is the other way to make money. So this is the difference between stocks. When he's 12, he's selling stock in his company. When he's 13, he's selling interest, right? He's selling an interest contract. So it's interest related. We would call that a bond, treasury bill, treasury note, commercial paper. All of these instruments that we can get interest from have nothing to do with the equity markets. They have nothing to do with what's going on in the Standard and Poor's or NASDAQ. Totally different cycle, right? This is the interest cycle. The interest cycle is what banks are involved in. And so we talked a little bit about a minute ago about when you go to one teller, there's one cost. You go to the other teller, there's one, cost. And so what happens is the banks are in this business of Evans Lawn Mowing Service year 2, right? They're out there loaning their money. So let's say a bank, well, you and I could do the same thing, right? Let's just start with you and I. So let's say I want to earn interest on my $100. So I'm not buying stock. I'm loaning my money and just like a simple bond. And let's say I own this. This is a coaster, right? It's kind of a small size coaster. I own a bond and it's guaranteed for 10 years to pay me 2%. So let's say I invest 100. In bonds, you go by thousands, but it's 100. So I invest $100 and I say, okay, every year I'm going to get 2% back. That's pretty good for 10 years. I'm going to get 20%. I'm willing, because I know that's going to happen. I'm willing to pay $110 for that because I know I'm going to get 2%, 2%, 2%, 2%, and they can't change the deal on me. So I have a 2% bond. That's pretty valuable. It's worth more than $100. But what happens is the interest rates change all the time. They go up, they go down, they go up, they go down. And they were flat for a long time until a few years ago. Then inflation happened. And to correct inflation, one of the things the government will do is raise interest rates. It slows everything down. And the idea is people will spend less and, slow down all of that to bring the inflation down. And boy, we're kind of in the middle of it now, aren't we? It's like, wow. Yeah. So, and there's so much debate about, are they doing the right thing? Is it too much? Is it too fast, too slow? All of that. There's always going to be that, right? Because there's a lot of moving parts in those big decisions. But let's get back to the 2%. So I own a bond that I know every year I'm going to get 2%. I'm happy, right? Then the interest rates go up and they go up 0.25%, then they go up another 0.25%, and then they go up 0.5%, then they go up 0.75%, boom, boom, boom. So now I can go out there and I can go walk into a bank and instead of a 2% rate, which we were excited about a few years ago, I can get 5%. That's a bigger coaster, right? So here's my little one. Here's my big one. So the big one is worth 5%. Well, I would pay, I might pay $125, $130 to get a bond where I know every year I'm going to get 5% for 10 years or longer, right? That's a good deal. So when I'm able to get 5% for this, and I could do it on, any corner where there's a bank right now. And what I already own is only 2% return, 2% interest. Which one has more value? 5%, right? So if I was going to buy the bond from someone who owned a 2% bond, I'm not going to give them $120 or $110. I might give them 80. It's still worth something, but it's deeply discounted. It's on sale. Nobody wants the 2% one when you can get 5% all day long. That's what's happened with the banks. So the money, when we went to Teller One, the money that they took from our passbook savings, and, we brought them the cash, right? The cash that's in the basement in the safe. And they took that and they invested it and they bought a whole bunch of these bonds for $2, 2%, billions and billions of dollars of 2% bonds. The value of them has gone down, 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 down. Well, now people go to Teller One and they say, I need my money. I need to make payroll. I need my money. I'm ready to buy a house. I need my money. I'm ready to move. And I have these expenses coming up in my business or my personal life. Can I have my money now? Well, I don't have it. It's not in the basement, remember? It's out on loan with these bonds. So I'm going to have to, as the banker, I'm going to have to go sell these bonds. Well, nobody wants to buy them. And if I get the ones that will buy them, I'm losing money. And that's happening with lots and lots and lots of zeros behind those dollars. That's the problem. So their banks holding these when they should be holding these. That's kind of a management issue, and that's all debatable. But they have bonds that are not valuable because the interest has gone up so much. So when you listen to the news, people will say it's because all the banks were told this is a very short season. We're just going to get through this inflation real quick, raise the rates, they'll come right back down. It's not going to be years and years and years. And then that's not what happened. And so all the banks got stuck with all these bonds. So what they're doing now is they're opening up all the tellers saying, bring your money in. We'll give you 3%. We'll give you 4%. We'll give you 5%, trying to get the money in so they don't have to sell those bonds at a loss, at a discount. That's what's happening. So, and it's not just one bank. It's going to impact all of them who kind of got stuck in this time warp of bonds that are valued less than the current ones. Does that make sense?
Yeah, and you brought up a very good point, because now that I really think about it, you are seeing more and more advertisements about CDs, 3%, 4%. They're trying to kind of outdo each other to see who can get the most in. I think I've seen it. The highest I've seen so far is like almost 4.8% on CDs and stuff like that too. So what you're saying totally makes sense now. It's like, because I've always wondered, I'm sure everybody watching as well has always wondered, how is it that I can jump on some of this stuff? And sometimes you can make great money, sometimes you can't, but I think when it comes right down to it, it's who you know and who you need to talk to. That's the obvious on that. One of the things I wanted to ask you though too is, in situations like this, because you mentioned before, everything fluctuates. It's like a roller coaster. You go up and down and up and down. What are some things that we should really pay attention to, or be careful with, right? The obvious one, like I said, is really talking to an expert. And if you don't have that, how do you even get started with something like that?
Well, one thing is to never be in a hurry. If you sense any urgency at all, either through a salesman or a banker or the time, if there's any sense of, anxiety or pressure to do something and you got to do it quick, like run to the bank, get your cash out now. You probably need to just take a breath and not hurry, because mistakes are made when people get in a hurry, and there's never a financial decision that you should make fast, right? Take your time, take a breath. That's the one thing where I see people kind of blow it. They panic, or they get an email and, oh my goodness, it's ground floor, I gotta jump, or it's panic, I better get everything I have and put it in gold, or take everything out of the bank and put it, in my underwear drawer, whatever. Don't do anything quickly. I think the other biggest mistake I hear from people of having made, or people that they know having made, is they don't keep balance in their financial life, in their investment life. And by balance, I mean you should have some interest instruments. You should have some bonds in your portfolio, and commercial paper and T-bills and things like that. And you should have some equities. And if you don't own a home, you should have some real estate equity. If you do own a home, or you own maybe too much real estate, you want to balance that with other types of equities and other types of loan instruments. So balance is a big one. Timing and balance, I think, are probably the two biggest mistakes that I help people unravel or calm down, and avoid. And then beyond that, I would say just slow, steady plotting. Don't get greedy. Don't overweight your portfolio in any way. You shouldn't have all real estate. You shouldn't have all bonds. You shouldn't have all tech stock, right? You shouldn't have all anything. You should have just a really well-rounded portfolio, because all of these different investment types have different cycles, different timing of their cycles, and they're impacted differently by things that are happening in the market, with different sectors of business, with government regulations, with interest rates. All of these things are impacted, and they have their own cycles. So if you have several different cycles employed at all times, there's always going to be something making you money. And just, to go back to the simple stocks versus bonds, when stocks are up, bonds are down. When bonds are up, stocks are down. right? There's this inverse relationship in those two. So why would you only have one and take that roller coaster ride that you mentioned when you can kind of even out the ride but still be profitable over time? And it's a way to hedge. It's a way to kind of protect everything. So you're not getting a 40% loss in your 401k, in a week. That would be someone who's overweighted, probably in equity, that had that kind of an experience. So you just want to, even out the ride. And I think that gives some kind of mental break for a lot of people. It gives you like an emotional, like, oh, I'm not so stressed because it's all in
Right.
that. All my, eggs are not in one basket, and I'm not betting all on one outcome in the game, right? It's just like you have a lot of games going. So those are the things just top of mind that I think would be helpful for people to consider.
Judy, also let me follow up with this as well. So if you're a new person, you have a financial planner, you have an investor, and you're getting into this for the very first time, right? I think there's a lot of things too that, and you mentioned this before in other shows as well, that we should there's certain things that people aren't aware. You talked about a great example was the bank teller, right? You get a piece of this and a piece of that, and I think folks are not aware also when they're investing too, because if people tend to watch TV, and if it goes down, they want you to sell and do this and then move things around, not giving the expert a chance to be able to work with your money and do the right thing for you. But I don't think people realize, and you mentioned this, there's always a cost with all of this stuff. You want to talk a little bit about that so people kind of are aware of what they're not really paying attention to?
Yeah, well, it costs a lot to advertise, a lot. And so if they have money to do all these television commercials or blast you're getting things you're getting in the mail, whatever it is, that's very expensive to do. So you have to kind of ask yourself, where does that money come from? Who's paying for that? And how can they afford that? Well, there's a profit built in, there's margin built in somewhere. Not that profit's bad or business is bad. I'm in business. I think business is great. But when the cost is so prohibitive, and if you actually knew what you were paying, you wouldn't. I think that's a problem. I think there's lack of transparency in a lot of transactions in the financial world. And I wish it was more transparent, where you know exactly what you're getting and exactly what you're paying, for that service or for that value. And there's a lot of things that happen in the financial industry that are not in the light. And so I think that's helpful. And so to help navigate that's always a hard one. I think having your own personal advisor is warranted, but the advisor you choose, you need to make sure is not part of the cog, right? Part of the system. And how you do that, you can look for credentials, you can look for a really good fit. We've got a great 4-H system of how to choose people on your team to serve you well. And it's not just how much they know or what bank they're sitting in or, how much marble they have in their lobby, not necessarily. Doesn't mean people that have that are bad, but you just want to consider people that are going to be advocate for you. So looking for like a planner, a financial planner that is fee only would be helpful. Looking for, even if you're going to the bank or a wirehouse or a broker dealer, someone that has a CFP designation, that's a certified financial planner, is probably a better bet than not. Because and they might be in sales, right? Most financial people are, which is not bad, but they at least have to have a college education and some education well beyond that about everything financial. So a certified financial planner has to know about estate planning. They have to know about tax. They have to know about investments, economics. There's a lot of things to that, not just how to sell you an annuity or sell you life insurance or, gather your assets and put them in a model somewhere, to try to get it to grow. And so that's probably one place to start if you really have some planning and taxation issues, rather than just, turn my money into more money. That's one way to go. And just be wary when there's an urgency for a product recommendation, like you got to do this today because the deal's going away or there's a time.
You got 2 hours left, right? That kind of deal. Yeah.
Run the other way. Because that's a conflict of interest, which is usually there in finances, where they're going to make a commission or money off you, which is okay because you just want to know how much it is. The more urgency, the faster they talk and the louder they get, there's probably a higher commission because they just get like this, hunger pains.
Yeah.
That's usually not in your best interest, especially if you have to hurry, you have to do it now, you're going to miss the thing, the door's closing, whatever. Um, that goes back to take your time. If you feel that urgency or that sense, they won't stop calling me, there might be a reason that that's not the best thing for you. And so just due diligence, do a little bit more work, maybe run it by another pair of eyes or two. Um, if you have people in your life that have done well with money and they are savvy and they're very grounded and balanced with that, it might be a relative or someone at work or church, that and it seems like they've done really well. Ask them to mentor you. Ask them what they've done or how they've made mistakes so you can avoid them. You can get advice from people that are not professionals, but they've had a good relationship with one or figured out stuff, maybe made the mistakes before you knew them,
Mhm.
so they could help you. Um, but a CFP is probably a good place to start. A fiduciary also would be a good thing to look for, and the accreditation there is AIF. It's an accredited investment fiduciary. So these are people, I have this in my background, but these are people that had to go to school. They had to learn how to sift through all the noise, sort through all of the products, all of the offerings that are available. Which bond should we go to? Which teller should we talk to? Which products should we look at? What should we be spending on investment management, if anything? And sort through all of that and then pick the best thing for you. Like, here is your roadmap. Here is your template, your model, your blueprint, right? And so you pay them to work on your behalf because they're fiduciary. And by law, the regulations say you have to, if I recommend a stock, I have to say all the other stocks we looked at, why that one is best for you, or a portfolio, or some product or bond or whatever. And you have to prove why that's the best thing for the client. That's very different than most of the world out there on the other side of the table when you're looking at investments. They don't have to prove anything. They just have to get you to sign so they can make a commission for their company, right? Or for themselves. Um, so a fiduciary might be another great way to go. There's a lot of great resources online. I've put some up. And mine is really the whole story, from my background is money truth. There are money truths. And when you know the basics of those, you can avoid mistakes. You can navigate really well for your family and for your financial future, and not get caught into some of these traps that either set you back financially or time wise. And I've helped so many people reboot, like start all over again because they made a mistake or something happened. It wasn't even their fault. The game changed. They couldn't do the job they used to do. The regulations changed. They moved. There's nothing available. Health issues. And so helping people reboot is it's fun for me because I get to be right in the front watching the transformation and watching them succeed and not, be in the same cycles. I've been here before. I've made this mistake before, and then you get into the shame and the blame and the relationship issues, all that stuff. Um, and so it's really fun for me to be able to help people do that. So I put up on the whole Money Truth side, there's a whole program there, Money Truth um, mastery program, online mastery program. So it's got courses and classes in every area of finance that impact you. So you can go there and watch a course or just take one class at a time. And a lot of it is delivered kind of like I talked today. Here's a story. Here's what you can take from the story, and this is how it applies for you. So I believe it's very relevant for most people. So that's there. There's also a book by the same name, Money, Truth, and Life, and that you can get on Amazon or anywhere that they sell bestsellers. It's a bestseller, and it's pretty valuable as a resource for a lot of people. But judycopenbarger.com, I think you've got it right here. Is the easiest way to get access to all of those resources that we've put out. There's things on YouTube. I've even got videos up there on YouTube. I just want to understand this little concept. You can go there and figure all that stuff out. Watch the videos. So all that's there for you. And I would say just grab a mentor, grab an advisor, get your team together. Make sure you have the right accounting support and you have the right attorney support for your estate planning and your business contracts, your business entities. Pull all of that together, get your team, make it strong, and you'll do well.
Excellent. And we're at the tail end of our show, folks. So you know what that means, right? we always have a challenge at the end of the show. So, what is your challenge for us today?
This is going to be a good challenge. What I'm thinking is, if each of you, now that you know the difference between the investments you have that own and the investments you have that loan, build a pie. Draw a circle and pen and paper, right, on your page, and then build a pie of how much bonds you think you have and how much stock you think you have. And so you can go through your statements. I think it's a great exercise to know. You might find that everything you have is interest instruments, or that everything you have is stock, and you don't really have much to hedge. If the market took a dip. So, I think that would be a really good challenge for you. If this is new to you, it might be a serious challenge. But just draw a pie. Ideally, a goal for most people. Again, there's different risk tolerance and horizons for every family, but you might want to consider around 70% equity and 30% interest, kind of as a target. And then you might go up or down from there depending on some other factors. But that would be a good place to start. What do I have, and what do I need to do to move toward that 70-30 pie?
Excellent. Folks, you've heard the challenge. And if you have any questions for us, please make sure you reach out, send Judy or myself a message, and we'll make sure that we get your questions answered here on the show. We are at the end of our show. If you're just joining us, please watch the beginning of the show. It's been very educational. You will get a lot of great content out of today's show, as well as every other show. And if you're not following Judy, please do so at judycopenbarger.com. We're here every Tuesday morning at 8, replays on Thursday at 8 p.m. So any last parting words, Judy?
Yeah, back to the coasters. So if you're holding a bunch of these little ones, 2% ones, you might want to run down to the bank and turn the 2% ones into 5% ones. All
right.
There's your goal for this week.
Sounds good. Until next week, folks, we'll see you guys next Tuesday. Take care, Judy.
Have a great one. Thanks, Carlos.